So market dashboard. We'll start with the majors. The way that I do it is that I split between major indicators for markets based on ETFs quoted in the US, liquid ETFs such as SPY for equities, TLT for bonds, UUP for FX, US dollar specifically, GLD for gold, IBIT for Bitcoin, and USO for energy, for oil. And what you can see here, so the impact on tariffs has been pretty terrible this week for the market. Like I mentioned in the economics section, that Trump, by managing tweets, by going back and forth between tariffs against China, Mexico, and Canada, retaliatory tariffs from these countries as well, until some delayed on the tariff as well. So a lot of uncertainties that rocked the boat this week and weighed on the market. But what I think is interesting is that this week we had both SPY, so equities, bonds, and the US dollar going down, which is unexpected, which is not unexpected, but it says something. So we've seen that the bonds are not the safe assets, at least since 2022. The bonds are the long-term bonds are in a drawdown of 40% at this time. So they have lost massively since 2002 and inflation. So they are no longer the safe assets, specifically about, when you consider the debt that I mentioned before. You also have the US dollar, that is usually another safe asset that went down at the same time. So what does it say? That maybe some money is leaving the US. It is investing the US through equities, through bonds, and then you need less dollar and buy foreign currency. That's a possibility. Now, what has become the safe assets in this world? The safe asset that has been the safe asset for the world in thousands of years, which is gold, which is one that has performed well this week, along with Bitcoin and IBIT as well. But it's more like this week 3% on a week is. It's within the range of the noise, so it's not really significant at this point. You can note that the Bitcoin or IBIT is down around 17% from the all-time highs. So considering that the Bitcoin volatility, it's not that big. The other thing that you can see from this is that oil has been down significantly as well this week. This is another indication that investors are considering the global economy to be slowing down, probably as well with tariffs that will limit exchange between countries. So that's I believe is something to be worthy of noting. In terms of market activity, you can see that the sigma ratio, which is short-term volatility versus longer-term volatility, is above 100%, which means that the market is slightly in tension at this point. Not only it's above 100%, but it's growing, specifically for equity markets. It's above. It grew 20% this week for both equities, and it grows 15% for the dollar. So there's there's some activity there. You see the volume ratio. It would be more interesting maybe on futures, but you see, excuse me, volume. Oh, I need to take a drink. Sorry. So volume ratio is increasing on sorry, so I'll try to get my voice back. I think it will be difficult. So volume ratio is increasing. I sound like RFK Jr. It's very difficult to hear, but it excuse me, it is what it is. Maybe I talk too fast, speak too fast, and too loud. I don't know. So volume and volatility are increasing, which is an indicator of higher activity in the markets. Things are changing, turning around, and happening. And we'll see that as well. So if you look at equities specifically globally, we see exactly what I've shown before, but with a spin, because you can see that equity markets were down, US equities were down, where emerging markets were up, global market were, except the US, were up, and Eurozone stocks were up as well. So again, that's another indication that we may have some transfer from the US to non-US, outside of US at this time. So is it a long-term move outside of the US, or basically simply a rebalancing between the US and other region with Trump and the global relationship between the US economy and the other ones in the world, and in terms of change in terms of geopolitics as well, that remains to be seen. But you see that what I would call the market tectonic plates are currently moving. If you see on equities, all the volatility ratios are above 1, so except maybe emerging markets, but they are all increasing at this point, and the volume is increasing as well. Bonds is not looking good, so it's mainly US bonds regarding ETFs. What I can tell you more than that, we have commodities. This is a section that I want to increase a little bit. I only have a couple of ETFs, but there's not that many ETFs available on commodities, so I should be able to get the same data on futures to be able to give you some significant data on this. But we see what I've said before, safe asset gold is going up, and basically the global economic activity indicator, to me, that is oil, is going down. So basically that's what markets are expecting at this time. We can see on Forex, Forex is pretty simple. We have the US dollar down and all other major currencies up at this time. Again, rebalancing or a long-term effect of tariffs, we'll see. But again, everything seems to be in tension at this time. You have volatility increasing both on the US dollar, on the euro. It's basically flat for the yen, and surprisingly, the volatility decreased quite significantly for Canada. But again, I probably that should do this on spot or futures, FX futures, rather than ETFs, where these ETFs in terms of dollar is not trading much anyway. But that will change in the futures. On the crypto side, no surprise, it's based on what I've said in the economy part, where Trump announced strategic reserve in crypto, but this announcement was rapidly disappointing, because first, not only Bitcoin, but it was supposed to include another group of cryptos such as Ethereum, Solana, ADA, Cardano, that kind of stuff, which I believe, XRP, Ripple, which I believe are not playing the same game as Bitcoin, in my opinion. But it was really disappointing, very rapidly, as Trump tweeted that the strategic reserve will be made of assets seized by the government. So it doesn't talk about investing and buying either crypto on the market to build that reserve. It will be mostly, at least at this time, built on assets seized by the government, which is why crypto market collapsed right away after jumping on the initial news. So we go back to the market, and basically the majors that I have on the first panel of the market dashboard, just to show you, it's not exactly the momentum, but it gives you the momentum here because this is the market change since 2024. So you see that Bitcoin is still leading the way. Gold, SPY is correcting a little bit. Oil is correcting as well, but since the beginning of January, since basically we started speaking about tariffs. If you look at oil, basically the story is pretty simple. It started moving based on the news of the Trump election, started going up with Trump being introduced as a, not introduced, I don't even know what he said that, but made officially president, and then as soon as we started speaking tariffs, which is bad for global exchange and global economy, obviously oil started going down. So this is where we are now. Maybe more interesting is the risk-adjusted momentum, which is an indicator of multiple time frames of momentum from 3 months to 1 year, adjusted by the short-term volatility. And what does it show you is that the actual risk-adjusted momentum collapsed in the US dollar. So that was interesting. Gold remained flat, but it's been flat for a couple of weeks now. The volatility is not increasing much. The momentum itself is not increasing much, but so this is where it goes. We see that oil risk-adjusted momentum has turned negative on the move this week. The bonds who were recovering before that, which was a good sign, for strategies for 60-40 or 60-40 or risk parity, has stalled with the selling of bonds this week as well. So basically the risk adjusted momentum flatlined at this point in March. So this is where we are. What else can I show you? So this is, I like to look at the spreads to see what, not only, it's cool to see what's going up, what's going down, but I think it's more interesting in terms of market dynamics to look at how markets behaved compared to each other. So you pick a reference here for equities, obviously it will be the S&P 500, and look at the different market sectors compared to the S&P. So here we see that the Qs underperform the S&P, but it's not really surprising. They are highly correlated, but there's a higher beta for the Qs compared to the S&P, so that's not surprising. But I think that it's more interesting to see the market action between the small caps measured by IWM ETFs, and the industrial and the more larger caps measured by the Dow Jones Industrial Average. So because I believe that what you see here is, in the context of a market going down, you see the spread widening between the Dow Jones and the Russell 2000. Or 3000, this one, I remember, who cares, but that's more, that doesn't negate the point that there's a flight to quality at this point on the market, from small caps to larger caps, and more basically potentially industrial stocks rather than pure technology stocks. I should have maybe looked at the Max 7, but I didn't. Here is the, when you compare the European equity indices compared to the S&P, you see the massive recovery that these markets have experienced since the beginning of January this year. It's pretty insane, So for instance, the French market was down 25%. It recovered 15% in 2 months. From the beginning of 2024, now the Euro stocks are regained all its loss of 2024 in 2 months, and Germany is leading the way by now being up 9% versus the S&P 500 since the beginning of 2024. So you see the huge turnaround that we could see previously in the numbers, a shift from the US to Europe at this point. I think that the beginning was motivated by the end of the war. The second probably leg is also motivated potentially by a shift induced by the tariffs. Again, this remains to be seen. I should have prepared a chart about this, but because if you look at the really long-term chart of European equity markets versus the S&P, it's a clear downtrend with some kind of blips up like this, but the longer term trend is down. So that would be interesting to see again if it's a shift, significant shift, or if it's just a short-lived stuff. Specifically, if we compare again to what happened with the tariffs in 2016, and then the market recovered. So we'll see if that happens again. What is this? So I think it's interesting often to check versus the versus gold, for instance. You see that the S&P versus gold is down when you have the S&P going down and gold going up. So you don't have to be a genius to figure that out. But since 2020, the S&P doesn't make any progress versus gold. At this time, it's going down since the beginning of 2024, and it's true for all the main assets, for bonds, for dollar. The only one that resists at this point, maybe, but it's at the same level over a year, is the equity, the European equities at this time. But they are also in a huge level of debt. So I don't expect, compared to gold at least, to be massively overperforming. So I'm sorry, I just want to remind you that this is not an investment advice. This is the banner that you've seen scrolling on top. I want to remind you a couple of things for I want to keep the regulator happy at this time. So this is not an investment advice. This is a market comment, just an opinion. that all investment involve a degree of risk, including the risk of loss. So that's very important as well. And that past performance, specifically when I show you performance of markets or indicators or whatever, relative, in absolute terms or relative terms, their past performance is not indicative of future results. So that's very important to keep in mind. So don't base, this is, again, the reason I'm doing this is also for me is that to get some time to reflect about the markets and be some food for thought at this point. But I forgot to put this, and I messed up in a lot of ways today, but this is what it is. So we had this week the S&P 500. You see how it looked. It didn't look very good. Last week, Friday rebound was very short-lived. It was probably some window dressing at the end of the month for many funds. And it went down again as soon as the next week started. One slight recovery. It was on Thursday or Wednesday. I don't remember exactly. But again, short-lived, and we made recent new lows. With again, volatility keeps rising in a very kind of stable way. It's not a market shock. Sudden surprise like COVID could have been. We are definitely not anywhere near COVID levels anyway, but it's just an example of how it can happen. Not even in August last year, when we had a volatility spike, on a very short-term volatility spike, where there were fear about the carry trade unwinding at this point. So this is where we are now. Okay, so, and maybe the last one of the last chart is one of the new that I shared in a post this week, which is two indicators of market activity. But it's another way to see the same thing that I've shown you in the first slide about of the market dashboard about the market activity. What you see here is that the relative volume and the relative the volatility are both increasing, which again suggests an increased market activity, which is natural in down market. But it gives you, when you see market activity turning around and starting going up, it's the time to take a look at what's happening. So I put this chart from 2020. You see that here there is no so in 2020 we had both volatility and volume starting going up before the market actually crashed. That again, it's not an indicator that it will crash. It's an indicator that is maybe time to pay attention to the market, because when everyone is basically quiet, doing their thing, the market is going up slowly, then there's no reason for people to extra trade. People are extra trading whether they are fearing of missing out or fearing of losing money, such as in bear markets. So again, the activity is interesting because this tells you maybe that's the time to pay attention to the market, and both volatility and volume are rising at this time. So maybe the next one, what is it? It's Bitcoin, but it will be replicating what I just said. The current drawdown on Bitcoin is around 18%. Last snapshot that I took yesterday. I didn't have the time to check this morning, but this is where we are. So yes, so I mean, nothing much more to add to what I just said. So that was the market dashboard.